The value proposition of owning the precious metals based upon all that stuff we've discussed in the past, the rehypothecated and over leverage of every single ounce of gold. It's priced as if it's plentiful when it's not. What's plentiful is all these other garbage derivative forms of gold. That's what's plentiful. But when the time comes and everybody wants their actual gold, as you mentioned, all the stuff that the U.S. has given away, and forward sold and leased out and everything else. When the time comes and everybody's scrambling for those ounces, there's going to be a rude awakening, and price is going to be revalued multiples higher.
The Federal Reserve is expected to cut interest rates in July, which could boost the price of gold. The gold price has already increased in recent months, and it could break out above $2,100 if the Federal Reserve cuts rates. This is because the gold price is often inversely correlated with interest rates. When interest rates fall, the opportunity cost of holding gold decreases, which can lead to higher gold prices. The current price of gold reflects its abundance. The total amount of gold ever mined is estimated at around 190,000 tons. This means that a lot of gold is available, and the price is relatively low. However, the demand for gold is also high. Craig Hemke, creator and publisher of the infamous TF Metals Report, believes that while the current price of gold reflects its abundance when the time comes and everyone wants their physical gold, there will be a rude awakening. The price will be revalued significantly higher. If there is a sudden rush for physical gold, more than the supply will be needed to meet demand. This will drive the price of gold up significantly. This is what happened in 2008 when the financial crisis caused panic among investors. The price of gold went from around $800 per ounce to over $1,900 per ounce in just a few years. Historically, the price of gold has increased significantly over time. In 2003, the price of gold was around $300 per ounce. By 2023, the price had increased to over $2,000 per ounce. This represents an increase of over 600%. This increase in the price of gold is not simply due to inflation. This is because gold is a scarce asset with a limited supply. As the demand for gold has increased, the price has followed. The renowned analyst also expects that despite the influence of banks, gold is not a lost cause. It serves as financial protection and continues to appreciate. Now let's watch excerpts from Craig Hemke's interview with Kinesis Money. Before we get started, make sure to smash that subscribe button and remember to enable post notifications to stay updated on our latest uploads. Thank you and enjoy the video.
What if, God forbid, I'm right about where this is all headed by later this year? The economy is in the tank here in the U.S. The Fed has to actually start cutting, like you have to expect them to do, and price takes off and breaks out. They can't restrain it, and it breaks out above 2,100, and people start to buy, and people are all of a sudden wanting physical metal again, and all of a sudden there's momentum to the upside. Well, what are they going to do then? I mean, I know they'll just reset and they'll try to defend a certain level and get short and flush the specs and all that kind of stuff like they always have. But the point of all this is it doesn't matter. I mean, even under this system, price will go up, as you said, at least in terms of how many dollars it takes to buy an ounce of gold. I mean, you just go back to 2003, it was 300 and now it's, 2,000. So it's not like a lost cause where, it's never going to go up because the banks control it. What it is it is financial protection. In the meantime, it's still going up like it's supposed to go. But then there's this value proposition once you get into the weeds and begin to understand how this pricing scheme works, where you understand that, again, it's priced as if the metal itself is plentiful and abundant, and it's not. Silver is as well. We know that, what the Silver Institute say, there's a 240 million ounce supply deficit last year. Silver also priced as if, oh God, there's silver. Hell, I can just walk out in my backyard. There's just chunks of silver laying around. Okay. No, what's abundant is the financialized derivative that's used to discover price. There's no restrictions on how many of those can be created. You look, and it's doing exactly what it should do. I mean, it finished the year last year at 1829. So it's up $150 year to date, 7 or 8%. Since the beginning of this century, it's annualized about 9.5 or 10%. So it's doing exactly what it should do. But everybody's like, oh, this is so terrible. Oh my. And why? Well, I think two things. Silver and the mining shares. Because gold's doing what it's supposed to do. All of my physical gold, that I own in all the different places around the world in all its different forms, I couldn't be happier with it. It's wonderful. What's frustrating to people and what makes people, give up is silver, which is the most heavily manipulated asset in the world, little tiny market, right? But also the mining shares, which people buy because, like silver, they want to make money. They want to make some fiat off it. Now, I'll admit, I think the fundamental picture for silver and a relative valuation versus gold and the undervaluation then of gold, which makes silver look even more attractive, is a tremendous, let's call it fiat making opportunity, which is why I own it. You can look at the precious metal mining companies the same way. You're like, well, this is like a leverage. This is like some kind of call option or something on the gold price. But they have their own all of them have their own fundamental issues and need a rising price. And so if you're in this and you own precious metal, physical precious metal for the store of value, sound money, lifeboat in a storm, they're doing exactly what they should do. And these day-to-day fluctuations are really meaningless. But the problem is so many in our sector are also, and I myself included, trying to make some extra fiat at this so you can buy even more metal. And that's what makes them maddening.
The price of gold has risen in recent months as the de-dollarization trend continues. If the dollar were to lose its status as the world's reserve currency, the price of gold could reach record highs. The United States' seizure of Russia's foreign currency reserves and expulsion of Russia from SWIFT accelerated the process of de-dollarization. Hemke believes that these actions prompted efforts by countries like the BRICS nations to establish an alternative global trade system, which may include gold as a stable component. As the de-dollarization trend continues, there is a growing demand for physical gold. If there were to be a true bank run on physical gold, it would have a devastating impact on the global financial system. Banks would be forced to sell their gold reserves at fire sale prices, sending shockwaves through the financial markets. In March 2023, the International Monetary Fund, IMF, warned that the de-dollarization trend could lead to a currency war as countries compete to devalue their currencies to gain an advantage. Let's get back to the interview.
To me, the central event of last year, 2022, the war in Ukraine, and you can come up with all these other headlines that are memorable. But the biggest event was the first weekend of March of 2022, about a week after the war started, when the U.S. did two things. They seized Russia's foreign currency reserves, about $300 billion, froze them, seized them, stole them, however you want to put it, and also kicked them out of SWIFT. And that action right there took that wheel of de-dollarization and gave it a big spin forward. And now efforts, anybody can just follow the headlines. Look for this on a weekly basis. These efforts being made by these, they call them the BRIC countries, to come up with an alternative system. Now, they'll need some type of trading accounting unit, some type of currency for all the global trade that they're going to conduct. And that's very likely to include gold as a basket, to give it some stability. So as that comes on, not even with, the impact that has on the dollar and, the traditional markets that we deal with, just the fact that that's now, those are going to be physical claims on gold. And that's what it's going to take to finally reset whatever this system is, a drawdown of physical metal. Every person watching us that can take an ounce out of the system and stick it in their safe is doing their part in ending this. Because, the banks will continue to lever and continue to rehypothecate and continue to create futures contracts and forward contracts and all the other crap, all this, financialized stuff. They'll do it all the way up to the end. But it's only a true bank run on physical metal that will break it. Now, it may come from other metals. I think we all should be watching copper. Goldman says above ground copper may be extinct by this fall. And if copper runs out of, we run out of physical copper or nickel or something like that, what's to stop relatively educated people from going, well, wait a second, if copper is like this, then maybe gold is too. So it might come from other markets, but it could also come from this de-dollarization or just simple recognition that the metal's not there to take delivery. And that's what we're waiting for. Just one last thing. You mentioned getting to this point. I always like to bring this up because I don't know how many people really know the history of all this. In that after World War II and making the dollar the reserve currency, the U.S. won the war, so we had all the gold. And the dollar was backed by gold. So people were able to use it and use it in confidence to rebuild their economies all around the world, you know? Well, then as countries did that, they started to accumulate dollars. And there were some countries that said, well, that's nice, but we'd rather have the gold, thank you. And the U.S.'s gold reserves have been cut about by 2/3 by the time we went off the gold standard and closed the gold window after the London gold pool failed. And so now there just wasn't enough gold for all of the fiat money that was being created to fight wars and the social welfare systems and everything else. And so what they do, they finally came up with some level of alchemy and created these financial products, which are considered to be as good as gold, really, but they're not gold. And this gets back, and the reason I'm going here is because you mentioned this when we got started. The Americans that think the GLD, oh, you know, they call it, I want some gold. So they call up their stockbroker, and their stockbroker says, oh, we'll put you in this GLD. You don't own jack, man. You don't own gold. You own maybe some short-term exposure to price. But if push comes to shove, that thing will just get shut down. You won't, and you can't get any metal out of there anyway. Only the banks can get metal out of there.
The price of gold is expected to continue to rise in the future. This is because gold is a scarce asset with a limited supply, and as demand for gold increases, the price is likely to follow. Meanwhile, the U.S. Federal Reserve signaled further rate increases this year to bring down inflation, while major European central banks hiked rates by a larger than expected margin. Those moves stoked fears that higher interest rates could weaken the global economy, causing a wave of cautious positioning across financial markets. This has also led to increased demand for gold as investors seek to protect their wealth from uncertainty in the financial markets. What do you think the future holds for the price of gold? Please share your comments and observations in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.